welcome, gentlemen. Some of the best hair in venture capital is on the stage with me today. We're going to get straight into it. Jerry, would you mind putting up the slides? We've got, I thought we had 30 minutes, it's now 28. But put up the slides, if you wouldn't mind, please, Jerry. We're going to take a little bit of a trip through public and private markets just to start off. You can see here, far right-hand side, the equity markets over the last 12 months, really from November 2021, have taken a real mauling. Usually, private markets historically are about 6 months behind public markets. Whether that's the case today, we'll soon find out. But far right-hand side, NASDAQ has taken probably one of the biggest maulings, and perhaps changed the way that investors look at what they do now with their money. In terms of a little bit of a contradiction, I guess, we're sitting on currently some of the largest amounts of dry powder, so the investable capital, not necessarily all called in the fund at the moment, but committed capital. And this is just the VC dry powder, $560 billion of investment looking for a home, right? And fundraising activity, here we're actually seeing far right-hand side again, 2022, that's only half a year, right? That's only to June. So enormous amounts of capital being raised. And in terms of what that's going to be used for, follow-on investments, new investments, this could be one of the greatest times to invest, but also perhaps in markets that are pretty volatile, right? So Chris, one of the longest running funds, and specific to travel and hospitality, in terms of what you're seeing in the private markets, does it reflect this 6-month lag from public markets? Are you seeing valuations actually under pressure at the moment?
Absolutely, and thank God, because it's been a little bit nuts the last few years. I think that public markets are always used somewhere in the underwriting formula, right? People will look at public market valuations and they'll use the same kind of multiples when underwriting or studying a private market company. So it happens fast. I think the reason we talk about a lag is that unlike public markets, our investments aren't marked to market every single day. Thank God, because it makes life a little bit more fun for us. But no, we're absolutely seeing the effects of the public markets in private market financing, and I think it's a very, very good thing and healthy for the ecosystem overall.
Yeah. Oliver, based in Singapore, focus on Asia. You tend to invest at a later stage, right? So growth capital a little bit later stage.
Right.
And in terms of where the valuation pressure is probably felt in the private markets, it is at a later stage because they're closer to public comps. What are you seeing in Asia at the moment? Is there pressure? Because you've got this build-up of dry powder and extraordinary fundraising.
Right.
Is it still an enormous amount of capital chasing deals?
Yeah, there's definitely an enormous amount of capital, although also that is, you have to kind of like peel the onion a bit, right? For example, growth equity, $20 to $100 million check size ranges in Southeast Asia is still underpenetrated, right? There's about $900 million of capital missing each year in Southeast Asia at that check size range relative to China, GDP adjusted, right? So that was a structural shortfall that was temporarily maybe a bit taken out of whack or filled, especially last year when there was a lot of capital coming into the market, but there's still that structural gap today, right? And that has actually kept valuations relatively benign at that sort of like check size range in Southeast Asia.
And also, I mean, one of the best ways to avoid valuation pressure is to extend runway.
Yeah.
Right.
Yeah.
So, how much do you keep? Do you keep some of your powder aside for follow-ons? And if so, how do you go about that?
So I guess it's a bifurcated question, right? So one, you have to look at the dry powder that you have on the GP side, so on the investor side, right? So, and there is a lot of dry powder that is reserved for new deals or reinvestments. That's sort of like good business practice, I guess, as a GP to do that. When you look at companies, the good companies are currently not out in the market fundraising.
Yeah.
The good companies actually mostly raised last year and have actually still a lot of runway to go. And maybe that runway lasts them all the way to profitability, which obviously would be ideal from a company perspective. So I don't even think the 6 months lag that you described is an accurate one, right? It actually may take way into 2023 for sort of like the multiples that you see in the public markets to trickle down, because only when a company is raising, you actually have that new mark, right, in the private markets,
So, Steve, you're actually investing JetBlue's balance sheet, right? So, typically, you would look at that as being perhaps a bit more strategic in terms of the investments you look at. Give us a view both sides. What should portfolio companies who are raising start to expect in terms of deal terms, right? Because valuation is only one part of the equation. You've now got, there's a vast array of actual deal structures and deal terms that can be put on the table. What are you seeing? Because there are a number of different ways to attack this beast.
Yeah, absolutely. So, I guess the first thing I'd say is that we tend to invest at maybe a little bit earlier stage. So, the public market multiples don't have as much of an effect at the earlier stage, simply because there's nothing to multiply by, right? We all know that the projections that the companies are giving us are kind of works of creative fiction, and so we try to put our own lens on that. But we are investing off the balance sheet, but we're also investing for a return. So we don't think strategic is kind of a code for this is good for the business but bad for our investing. And we're investing in things that are, so we use the strategic fit as kind of a way to prioritize. So we've got basically 5 themes we're investing in that are kind of line up with the corporate parents' priorities. Sustainability, next generation operations, accommodations, the seamless customer journey, and distribution, loyalty, and revenue management. So that's kind of how we're kind of going to the market these days.
And are you seeing more debt funding, or what are the different terms around equity funding? Right?
Well, and I think what we're seeing is that one of the ways that people are trying to who do need to raise money, are trying to avoid recognizing some of the valuation corrections is with structure. So they're offering other terms to investors that give the investors maybe less downside in exchange for keeping the valuation up. So
liquidation preferences,
better liquidation preferences, liquidation preference multiples, warrants on top of the equity investment, so that there's additional upside. All kinds. I think people are going to get very creative on structuring as they
more than before. I mean, Chris, are you seeing that as well? Different styles of deal structuring, or
yeah, I mean, a lot of people, I think, are trying to use safe notes, just real simple ways of sort of kicking the can down the road on valuation. But that's just, I don't think that that's the right solution, and it's not what investors are looking for. And I think it's important for entrepreneurs, everybody in the audience who's building a company, to sort of come to terms with the math of valuation. I mean, it really got overblown as sort of the key metric of success, right? I'm a unicorn now, or all of that doesn't make any difference if the company ultimately fails, right? So a lot of, I think, people run the math poorly when they think about ultimately the outcome for them as founders, and those teams that are chasing valuation and trying to use creative structures to hold on to a fantasy of valuation, I think, are wasting time and are distracting themselves. And the smart entrepreneurs, I think, are just saying, hey, markets have changed. I'm building a business here. It requires so much capital. What the market prices it at, I'll take that. It's appropriate. Let's go on and build our business. So it's important, because I do think that the cost of capital has increased, and it will now, I think, be a new era, back to the old era, that's going to last several years. So don't waste time chasing the valuation dream. It's a false flag.
Because often it's just about cash runway, right?
Also, that was very self-interested comment, so I will admit
Spoken
that.
by the man who's trying to talk down your valuations. Manpreet, sorry, Steve, did you
I was going to say, I completely agree. I often counsel entrepreneurs, don't chase after valuation.
Yep.
Find the right investor who's going to add value to the company, and you may wind up with a smaller piece, but it'll be a much larger pie.
Yeah. Manpreet, you've just raised $600 million at Jungle, right? So no wonder big smiles, right? Great opportunities coming up. This chart here, it's about the private capital fundraising by region. So Asia got up to almost Europe levels, coming back off a little bit, probably more a China reflection than anything. In terms of your focus, Southeast Asia, India, is India the beneficiary of a China freeze now in terms of capital allocation, or are there just fantastic underlying opportunities that are now emerging?
I think the answer is somewhere in the middle. I think let's step back. Over the last maybe 10 to 15 years, a lot of money has been made by US capital, European capital investing into China. For whatever reasons, and we won't get into the reasons, that door seems to be a little bit blocked. They've generated enormous returns in terms of doing that. Now, if I look across the world, I think the only regions where there is still an element of growth which is still coming through is India and Southeast Asia. If you look at the US, they're talking about a recession, right? At least they know what they are fighting. They're fighting inflation, and they're very clear in terms of what they want to fight. Europe is somewhere stuck in the middle. They're figuring out what they need to do to spur economic growth versus fight inflation. So there is no growth which is coming in.
Yeah.
China, for whatever reason, seems to be a little bit of a closed door for them.
Yeah.
So if I look at long term, a lot of capital, and let's not forget, we are venture capitalists. We have a 10-year horizon. And these things are cyclical in nature, right? So from that perspective, I think the attraction for India and Southeast Asia remains immense. The second thing that I also argue that a lot of tech which is being built out in India is particularly meant for domestic consumption, right? So I would see it as, from a capital perspective, India and Southeast Asia are attractive destinations. And from a business build-out perspective, there are very large domestic markets in the vicinity out here. India is huge. Indonesia is fairly huge, right? So from that perspective, that's the way a lot of capital tends to look at it.
Yeah.
And that's a broader theme which seems to be coming
That's
through.
right. I mean, in August, there were 10 IPOs listed in PitchBook, and 9 of them were in China, right? $1 billion IPOs. So India, great, incredible domestic market, not yet at the stage
I think the
China.
IPO part of it gets kind of pushed a little bit, but I can tell you that why do you do an IPO, right? Broadly, 2 reasons. Number one is when you have exhausted all avenues of private market fundraising, for the simple reason is that you have now reached a certain valuation where we think that public market is going to give you that money, right? And that's the reason we go and do an IPO. Or there is a need to provide exit. Let's be honest, there is a 10-year horizon, etc., which is what drives IPOs. So my suspicion is that a lot of IPOs will start getting pushed out, and we've already seen that happening. Does that make them bad companies? No, it doesn't. It's just a reaction to what is happening in the market, and it's a logical reaction to happen in the market. The second thing is we have to also understand that a lot of local markets, particularly Singapore, Indonesia Stock Exchange, even the Indian Stock Exchange, I don't think so they are mature enough or deep enough to understand what it means to list tech businesses, right?
Yeah.
So, one of the things which we always counsel some of our companies is to say that, look, there is always a dream of saying that a US listing, not that there's anything, it's just 2 simple things. It's an incredibly deep market, right?
Yeah.
And the second is that they seem to have the level of sophistication, what it means to value tech organizations, right? So that's the way we look at it, right?
So what we've got here is looks like the party's over for a little while at least, or was, the period during COVID just an extraordinary blip. Oliver, you're again, later stage investment, probably some of the investee companies that you're in are closer to unicorn status or in fact already there. Is it important? Is it more important just publicly, or is it really important to your LPs as well?
Yeah, so we hate that term, actually, unicorn. We always at Asia Partners say we believe in rhinos. Number one, they're real, not like fairy tale animals. And then they're sort of like a little bit more sturdy, down to earth, kind of like resilient, right? And also they have a real horn. not sort of like just something that looks funny.
And this would have reflected, again, quite a lot of, you can see there in the US, I mean, you know, incredible representation there in the US versus elsewhere. In Asia, yeah, probably again, China skewed. And we'll probably see that come off a little bit. Where are the next unicorns in Southeast Asia?
So let's call them rhinos.
Rhinos,
Yeah.
okay. A non-mystical animal with a real horn.
That's right, that's right.
So, yeah.
I like it.
So we have a certain sort of like checklist that we look for in terms of companies for us to assess, right? Do they have the ability, right, to actually become rhinos? And ultimately to list on the US markets. I agree with Manfred, that's sort of like the destination of choice here, to use travel lingo. But I think from our perspective, it starts with the business model. It's always easier if there's already a China or a US peer that is publicly listed in that same business model. You have basically a plethora of investment managers at long-only funds, etc., right, that are already familiar with that business model, right? Why reinvent the wheel? So that is actually quite important. We look at it from a perspective of multi-market proof points in Southeast Asia. Given this is actually quite a diverse region, it is hard to operate across 6 markets. So very different to China, India, or the US. So if you have demonstrated that you can already make it in 2 to 3 markets, then you probably have a good shot to make it to all 6. If you're still stuck in your home market, maybe a bit more difficult, right? We don't want to take that execution risk. And last but not least, it's all about the financial profile, right? So you have to have a minimum level of gross profits in order in the foreseeable future to be able to be listable in the US, right? So from our perspective, the minimum threshold that you have to hit is 25 million of gross profits. If you do the research, if you hit 25 million of gross profits, if you're sort of like this year or near-term profitable, then you have a good shot at attempting that public listing. So if a company fits all those criteria, and actually many of them do now in Southeast Asia, then it could be a good candidate to get on that list in future.
And is it more likely B2B or B2C is going to drive the next rhino?
So we are big fans of marketplaces, and they come in all facets, right? C2B, B2C, B2B, C2C, B2B2C, you name it, right? Whatever you like in that letters, in that alphabet soup, right?
Anywhere, it's going to come from
That's
anywhere.
right. And the reason for that is it's fragmented markets, right? It's usually like two-sided marketplaces, long tail supply, long tail demand. If you have that in place, you can create actually quite a strong position as the marketplace in between. And then usually that leads to all these criteria that I mentioned before.
I think just staying with this, right? I think we are aligned, Oliver, you and I, on this one.
You're joint investors, right?
So we are joint investors in a lot. I actually first, we were at Flipkart. I helped make money for you, and now we kind of help other people make money, right? But anyway, so the challenge with the unicorn is, the way I look at it is it's a milestone. It is just one step in the right direction. A lot of people end up getting fascinated by saying, I'm done. So, similar to the way the thinking around the table out here is, we've always been obsessed about profitability and metrics. I'm not saying we need to be profitable right now, but we spend a huge amount of time working with our businesses, and a lot of our businesses are very smart about it, is to understand is that what is your profit margin, what is your path to profitability, and how realistic is the expectation in the path to profitability. So for example, if you're disrupting a business where there's, let's say, 2% margin somewhere, and you are saying, oh, I'm going to get there because the margin is going to go up at 4%, let's think and pause and think back, right? It's like, how are you going to make money, right? And what is the margin and what is the sustainability of it?
So you mentioned founders, right? And actually, or this is all based on the founder. And at Jungle, you say, we only exit with founders. Everyone's looking for this mystical feature that's the perfect founder, right? What difference does that make for you that you only exit with founders? I've not heard that term before. We've heard investing in founders, but not only exiting with them.
What has made Jungle unique is that we've always believed in building organizations or building businesses which are built to last, right? And I think exiting with the founders is to say that, look, if we go in with the founder, we are in the journey together. So it's not I am an investor. Yes, I have invested money, but we also work along with the founders to make sure that we build the sustainable businesses. And what I mean by exiting in the founders is that we have a common goal. That is, we need to build a sustainable business, right? And that is why I keep harping, and I'm very glad that the valuations have come down, because a lot of them were revenue multiples. And at the end of the day, a revenue multiple is meaningless unless there is a certain amount of profit attached to it, right? So in many ways, I'm super excited about what is happening, and it is because the business is now being attuned into fundamentals, right? So this is what I'm saying, that the business got flabby. Now you're being put through a crash diet, you're going to get it thin, you're going to get nimbler, and whatever which is there.
So support and mentoring, etc. Steve, sorry.
I just think that it's important to, insert here sort of just a reality check for the innovators in the room. We talk, and it's unfortunate this idea of the unicorn, I like the rhino concept better, has become sort of part of the startup narrative. I think it's become a real disservice to founders. The reality is, it's a reference to the phenomenon of private markets becoming more sophisticated for growth stage financing, secondary markets, creating liquidity for shareholders without having to be public. It's just all a bunch of funny math. It means nothing about creating value. And I think that there's so many people who are energetic, entrepreneurs who want to do something, who want to build their business, who are somewhat deflated by the notion of it's either a unicorn or it's somehow not important. And I think that's completely wrong. Our industry, we move capital, large chunks of capital, and we look for and underwrite for very high growth and returns. We have to, because we have investors that have expectations. That's not the only way to finance a business.
No.
And there are so many, especially in travel, there are so many dynamic and interesting things happening. Disruption, is the great sort of mother lode of invention, and that's happening across this industry in ways that are profound and likely to be long-lasting. So I think it's very important for startup entrepreneurs and anybody thinking about starting their own business of any kind to just dismiss this idea of that if your idea isn't going to be worth $1 billion, it's not worth something. That's just a fallacy.
Yeah, there's a lot of money to be made in between, right? There's a lot of value to be created.
It's not a bad. I know people who have created great lifestyle businesses, taken the appropriate amount, small amount of dilution, subsequently sold those businesses years later for 20, 30, 40 million bucks. That's a lot of money. That's a lot of money, right? So
Steve,
that's worth chasing.
Yeah, Steve, when a founder comes to JetBlue, right, they're expecting to be able to leverage what JetBlue has in the industry. What does it mean for a founder, though, to come to JetBlue? What's the difficulty in actually integrating? Because it's a little bit like oil and water, right? Because you've got someone with a startup mentality coming into an organisation, a big corporate, but they're expecting more than money. Right. So how do you deliver that?
Yeah, no, absolutely. I mean, I think we have a little bit of an advantage. JetBlue is a relatively young company, right? I mean, it really has only been flying commercially for a little over 20 years. So it's still a pretty flexible, dynamic, entrepreneurial organization, which certainly helps. But we are always looking for cutting edge innovations. We have sort of a sliding scale, so there's some companies that we see that have innovations that are really actionable today, and we do a lot of work to try to connect them to the right people within JetBlue. That obviously helps us because we get to learn from those interactions, and they're JetBlue is a customer, so potentially, so that gives us terrific perspective on the business. But it also is a way for us to kind of demonstrate our value to the entrepreneurs, and that helps us to get into the best opportunities. There are other things that are much longer term, right? So you think about things like we invested in a company called Universal Hydrogen that's developing hydrogen fueled propulsion systems for aircraft. It's going to be a while before they're actually selling anything for commercial service, but that's a great opportunity for us to give them feedback as a potential customer of something like that. And it's a great opportunity for us to learn about where that's going. So I think we've actually had a pretty good track record, I think, of finding companies that meet a need for JetBlue, and I think if it meets a need for JetBlue, our thesis is it meets a need for a lot of others. So for example, we have a company in the UK called i6 that's kind of digitizing the fueling process. JetBlue has been using that technology initially at our Boston focus city, and that's I think going to expand across other focus cities. An earlier example was Tomorrow.io, used to be called Climacell. It's a weather technology company, which is now being used, I think, at all of our airports to help understand kind of the short-term weather forecast and figure out, how that's going to impact operations on the ramp. And I think that's been hugely valuable for these companies because it gives them the validation.
Yeah, go to market that's a little bit easier. I want to get to metaverse in a moment, but I've got a question for Oliver, and it's relevant for Manfred as well because it's Red Doors. You recently referred to Red Doors as a marketplace, right? That kind of didn't really resonate with my expectation of a marketplace, but all I could think was you're going to become an OTA. Red Doors is going to become an OTA. We're friends. Nobody else is listening.
Sure.
Is that the case? You're going to become an OTA?
So I think what we've seen in travel, right, is what we call sort of like OTA 2.0 to a certain extent, to use the typical tech lingo here, which is like you are a marketplace fundamentally because Red Doors connects thousands of hotels on one side to millions of travelers on the other side. But you actually go one further step in terms of not only providing the marketplace, but you're providing basically a branded franchise, you're providing the channel management, you're providing sort of like the software to run those hotels. You're becoming like true partners to these hotel owners, which are often sort of like single property, type of owners. So you're almost like a bit like a McDonald's franchisor. You're
like
looking for franchisees,
maybe,
around the globe, and that is, from our perspective, a very defendable value proposition, right? Because especially if you're operating at that price point that Red Doors is operating, which is sort of like 1 to 2 star, so like unbranded, mainly domestic business and leisure travel in big markets like Indonesia and the Philippines, you have to. It's actually very hard to kind of like fully own and operate that segment, but you have to promise the customer, a certain minimum level of service quality, right, that your brand stands for. And how to do that in a tech-enabled way, that's really what Red Doors is about. And they thrived during the pandemic. They doubled their revenue 2 years in a row. Helped by being mainly a domestic travel platform, but nevertheless, that is quite an accomplishment by the team.
So just 2 minutes left. I want to move to metaverse, and this struck me as we talk about metaverse, talk about Web 3, Web 3.0. So I went to Web 2 to find out about Web 3, right? Typical move. But the definition here of Web 3.0 is actually incorrect. It's more correct to be Web 3, but hey, I'm not an expert. In terms of just a rapid fire, which area of Web 3 are you looking to invest in?
Okay, so first of all, I still think there's a huge amount of opportunity left in whatever web you call it, which is that if you look at travel and leisure and tech, a lot of startups focus on generating revenue and driving business. There is not enough which we see activity in terms of what does it mean to drive profitability in terms of bringing your costs down. So for example, labor is a huge cost factor which is there. Are there solutions out there which can help manage your labor costs? So that's a business which we have invested in because we like it. It helps you bring down and manage your labor costs. It is about your consumables, right? So you buy paints and there's maintenance, etc. So that we still think that there's a huge untapped opportunity out there.
Well, there's there's a $40 billion market in consumables for your avatar. So there's massive opportunity. Steve, in terms of metaverse, in terms of Web 3. Any specific area?
See, we're going to still wait and watch on this one. I'm still trying to wrap my head around what it means.
Yeah.
I'll be very honest.
Chris?
Look, we're only interested in, novel, defendable solutions to real problems. And whether that is a blockchain component that actually should be there or some sort of a VR component that makes sense, doesn't matter. So these categories are sort of false. Our view is strictly, is it a novel, defendable solution to a real problem?
How does it deliver something? I think there's real value in the crossover between Web 2 and Web 3. But Steve, you say picks and shovels?
Yeah, so look, I think we see people trying to deploy, Web 3 and the blockchain and everything from, ticketing and loyalty to, maintenance records and trading of sustainable fuel credits. It feels to me like it's a hammer looking for nails, and so I want to be in the hammer business.
Very good. Well, we've run out of time, unfortunately. Lots more questions still unanswered, but I'm going to get in touch with the guys and get it in writing, perhaps, so we can share with the rest of the group. 30 minutes is never enough, but please join me in thanking Oliver, Chris, Steve, and Manpreet. Thanks very much. It's great. Thanks so much.